What's up everyone, it's Caddy with Money Investing. In this video we are going to be talking about SOFI, ticker symbol SOFI, which shots were fired. We had an analyst at Wedbush pretty much downgrading the stock to a neutral, or actually underperform rating from neutral, and putting a price target down to $2.50, which was about a 50% expected move lower from SOFI. It was down a little bit over 9% yesterday, but then of course got bought up. And in this video, I'm going to break down exactly what the thesis was and then try my best to explain as much as I can what the end result might look like for SOFI moving forward. Now, I do understand this. There is a very strong bull bias among investors on SOFI. So I got to be very, very clear here. I'm going to be objective. I'm not going to feed into your bias because right now, if I tell you SOFI is a shitty stock, I'm going to get so much comments down below. That's just a fact because of the bias. So I gotta be objective, and may hurt some feelings here, but it is what it is. I'm gonna give you straight up. So hope you guys enjoyed this video and find it helpful. Make sure that you drop a like. Don't forget to subscribe to the channel if you're just joining us for the first time. Link to our Discord and Patreon is going to be down below if you're interested in joining us, and of course getting access to our buy and sell alerts, options alerts, trade ideas. Everything's going to be included, as well as the 16% annual discount that does expire at the end of this month. So okay, let's just dive right into it. First things first, let's just go over exactly what the thesis was, right? So SoFi shares down more than 6% pre-market. This is from yesterday. So after Wedbush analyst, by the way, I've looked into his rating and it's not good. He doesn't have a good track record. But that doesn't mean we don't listen to what he has to say, right? Downgraded the stock to underperform from neutral, cutting the price target down to $2.50, pretty much cutting it down to half because it was trading at $5. And the analyst told investors in a note that fair value accounting may present headwinds for the company. And the personal finance firm's share price is trading now around $4.70 per share. And the analyst explained that the firm believes SoFi may be nearing a tipping point on the fee income it recognizes related to the loan origination and sales, while capital levels may be overstated using fair value accounting. And they think the company may look to raise capital this year to support growth. So in a nutshell, this is very similar to what Silicon Valley Bank, what other regional banks are going through. By the way, the analyst that did the downgrade is one that's specifically focusing on regional banks. And since SoFi got its bank charter, they're now considered as a bank. So it also kind of falls under his purview to look at what's going on in the balance sheet, assets and liabilities. What does the company actually own? And what are their capital ratios? And I think that's really where the risk is coming from, or at least the downgrade is coming from. And it's kind of like a very similar situation is what they're seeing with SoFi with respect to some of the other banks out there. And believe me, most banks are in a very similar situation. You put a bag and you kind of put together 20 names of banks. You pick a chit from that bag. Chances are you're going to find a bank which is underwater on its loan deposits. Of course, loan held to maturity and held for investment, held for sale. Assets are all underwater because of the loans that they have originated over the years in a low interest rate environment. As interest rates have gone up, the value of these loans have obviously come down. So chances are most banks are going to be in a very similar situation. Now, in a hypothetical analysis in which we applied the held for investment or held for sale, really, CECL accounting methodology, which is basically a methodology that's called current expected credit loss model. And the factors that they take into account with this type of methodology is really just all based on forecast. They're trying to anticipate what is the actual value of these loans that this company has made, right? In this example, SoFi, what is the actual value of all these loans that they have originated or they have basically created? So they're looking at current conditions, they're looking at past experience, and they're looking at future expectations. So no specific instruction in the literature on how to measure the probability of losses. It really depends on the analyst, right? Anybody can use this methodology and try to figure out what is going to be the real probability of loss for any bank out there based on this current expected credit loss model, or CECL. And according to this analyst, they're kind of putting it in terms of 60% downside for the book value, the tangible book value for these loans that SoFi has made, which comes out to about $1.27 per share of book value, which is down from $3 And they also, mentioned a little bit about the regulatory issues and how regulators are gonna start being more, strict and more scrutinizing all of these companies' policies and the capital ratios, and they're gonna force these regional banks to be more conservative with the way they use capital because, again, most banks, like I said, are underwater at the moment. Now, going back to some of the things here, this right here is going to be the balance sheet, and what they're really talking about is that the loans held for sale, the personal loans, the student loans, and the home loans you see over here, which is, again, an asset for the company because that's a debt instrument for SOFI. They've pretty much originated these loans and they have basically given it out to the borrowers, and the plan is for them to basically sell this off to investors, right? That's their business, right? So if you basically originate or create a loan, you basically, the borrower is, in this example, an asset for the person who's creating that debt. In this example, it's SOFI. And the idea would be, once the loan is originated, to pass it on, to sell it off to an investor that can generate that stream of income from the borrower, right? Whatever that rate of return looks like. Now, this is, roughly at around, this is majority of the balance sheet right now for the company, which is roughly around $15 billion, give or take a few billion here. So, but that is really the loans held for sale. Personal loans, student loans, and home loans is what makes up majority of their assets. And total loans right now are sitting at well over $16 billion off of a $22.4 billion overall balance sheet. And of course, goodwill is sitting at about $1.6 billion. So if you take that out, we're looking at roughly $20 billion, and of that, $16 billion is worth of loans, obviously, because they're in the business of lending. Cash and cash equivalents sitting a little bit under $2.5 billion. Now, deposits is a liability for any bank, right? So deposit is the money that you're putting into a bank is a liability for the bank, an asset for us, because we're the ones putting the money in our bank. So deposits is about a little bit over $10 billion, and total liabilities right now is sitting at over almost $17 billion. So the idea behind this thesis really is that the value of these loans is declined or declining because of the higher interest rates and the different fair accounting method. And the liabilities obviously are stagnant, they're constant because they're deposits, right? So they're sitting at over $10 billion. So in other words, they may need to raise more capital, is what that thesis also mentioned, that they may need to raise more capital in the future to sustain their growth. That's what they mentioned. The company may look to raise capital this year to support growth because they're mentioning that the fair value accounting, if you use a different type of accounting methodology, their actual book value is much lower, materially much lower than what they're suggesting it to be. And because the liability is staying constant, of course, they're in a very similar situation to what most banks are. So that's where we are with this thesis. This is, again, how many shares are being shorted for SOFI. This may have something to do with the report, right? So 97, close to 100 million shares being sold short. Percentage of float is a little bit over 12.5% right now. So definitely a little bit on the higher side, but obviously not as high as some of the other companies out there. Now, one thing I do want to point out with the analysis here is that SOFI's business has changed. I think we have to understand that, it started off as a very strong student loan origination business, right? Back in the first quarter 21, you can see by the time third quarter 21 and fourth quarter 21 rolled around, student loans were the main driver of our overall loan originations. And even home loans were pretty big back then at almost over $500 million. And over time, you can see the most recent quarter, and I pointed this out specifically in my more recent video on SOFI, which again, you can go back and watch, is that they have shifted the actual loan origination mix from what was first a student loan origination and maybe even home loans to now strictly a personal loan business, right? That's what they're really doing now. Personal loan originations, if you come over to the first quarter 23, what they reported, $2.9 billion, right? That's the number. And that is increased from $800 million in the first quarter 21. So in 2 years, we've seen a growth of well over 200%. And not to mention as a contribution mix, if you do the math, 2.9 divided by 3.5, 82%. 82% of their loan originated in the first quarter 23 was a personal loan. And only 90 million was a home loan, right? As I mentioned in my previous video, that seems to be a lot more risky dynamics for the company's overall revenue mix, for origination mix, right? So if you take a look at the contribution here, 82%, versus if you come back to, let's say, the first quarter 21, which was back then at 805 divided by 2545, only 31%. And home loan back then was, let's see, 703. It was at 28, almost 29% to versus now, which is 90 divided by 3,566, only 2.5%. Think about that for a second, how that has changed for the company over the last 2 years. So no doubt, that this has become slightly, I would say, a little bit more of a business which is dependent on very much on personal loan origination, which is also why they're suggesting that fee income might start to come off a little bit because student loans and home loans are not being aggressively originated as opposed to personal loans. But I think the first part of the argument, which is to say that their capital ratios are going to be scrutinized, and not to mention that the loan values are declining and the deposit base is pretty stagnant, that's going to be a very similar situation. Well, then who isn't? Which regional bank is not? Which bank is not in that situation, right? Most banks are. Most regional banks are. The question we need to ask ourselves is this deposit base at over $10 billion, is that at risk of flight, right? That's really what's going to happen. Like a bank run happens when deposit outflows happen, and at the same time, the company itself doesn't have enough assets to meet up with its depositors, right? To meet in terms of what the depositors want is their money, right? They want their money back, and assets are so much underwater, they need to have these forced sales, and as a result, the company pretty much goes upside down, right? That's what happened with PacWest, that's what happened with First Republic, Signature, you name it. There was a deposit outflow, a bank run, and these companies were forced to sell their loan book, right, at significant losses to kind of meet up with the deposit base, and even then, they weren't able to sufficiently, basically make whole of all their deposits. So the real question is, can we actually see depositors leaving SoFi, right? And I don't personally see that happening, right? So as long as they can stay in the business, obviously, and these are, even though they're loans held for sale and they might end up taking a small loss and a write-off for these losses, but if they can hold them for maturity, then of course they are fine. They're going to get their principal back. But then of course you've got that discussion of who they're lending to and how much risk does the borrower have. That's a write-off of about 5 to 7%. I think this is what they've mentioned is that what they're charging off on their balance sheet. So again, I think it's a little bit more, I would say, like from 2 years ago, SoFi has become slightly more risky as a business, but it is moving in the right direction, and it is in a very similar situation than what most banks are. So it's nothing out of the ordinary that SoFi is doing than what most regional banks and other banks aren't doing. So that being said, I think support level is going to stay put at $4.15, $4.24.15. This right here is going to be that level to watch as a support, and resistance is going to be at $8.64. I'm very much on the fence of actually buying SoFi once and for all, and being an investor here. I might start with selling cash secured puts. I think that's a much better way to do that. I might look at $4 strikes here over the next few months and see what the premiums are like. And if I can get like 2%, 3%, I'm happy with that collateral, return collateral. But yeah, that's where we are. Support level is going to stay put at $4. I think Anthony Noto might have picked up some shares yesterday when it was trading at roughly at lows 445, 450 around those levels. But of course, buyers stepping in and pre-market, it's up a little bit over close to 80 basis points. So let me know your thoughts down in the comment section below. What do you make of this report? Are you buying, selling, holding? What are your thoughts? Let me know in the comment section below. As always, if you enjoyed this video, find it helpful, make sure that you drop a like. And there's both pros and cons. Not completely dismissing the downgrade or the thesis, but then also not fully favoring the thesis either. But let me know in the comment section below, what do you think about SoFi? As always, happy investing, and I'll see you all in the next video.